All right. Thank you, everyone, for joining us this evening. As we go through some assets, we're going to be talking about a couple of assets that and how it's going. So we'll talk about Treetop and also another asset that we currently have under contract and actually has a few slots open for investment. And that's something a little different that we've never done on this show before. We've never offered an asset on this show before, and we're not pushing it. We're just showing you what we're doing, and we would like some feedback on what you think about our deal as we explain it. And our most amazing asset manager is on the show with us today, Gabriel Craft, and he'll be sharing a lot of in-depth knowledge on these apartments. So let me share my screen for just a moment as we get started, and let's carry away with it. So again, a disclaimer: this meeting is not legal or financial advice. It is simply investors sharing what we do and helping others to advance their game of investment and possibly learning how to invest in apartments. That's what we do here. So your hosts today are Dr. Sanjeev and Nikki Mall, Asif Kumar, and myself. And we acquire apartments and we offer investment opportunities to individuals like you and I, and we operate these apartments with a specific business plan in mind, and we'll be talking about that in detail in just a moment. And so our most amazing guest on today is Gabriel Craft, one of my own partners, one of our partners and asset managers on some of our the deals we're talking about today. So we want to give a report. And so without further delay, I'll introduce Gabriel Craft. Gabriel, tell us a little about yourself and why we should be listening to what you have to say.
I feel like I've aged a ton. So Gabriel Craft here. I live in Collin County, which is a suburb of Dallas, Texas. Been out here since 2016. And before I dive into anything related to asset management or buying apartments here in Texas, I'll just share a brief background. I think like many of the people that are going to listen to this, and hopefully a couple of the people that have joined us live can relate to this. I was given the information that you all were, that you got to go get a great education, get a college degree, and come out with that college degree, and there's going to be a wonderful middle class sitting and waiting for you. So, like many people, I took that very seriously. I did what I was supposed to do. I got not just one degree, but many degrees, and ultimately came out into a workplace that didn't really have a middle class. It had a working class, and it had a class of people that owned stuff. And so in about 2016, I finally figured that piece out, that there was a lot of strength in owning assets that allowed your money to make money for you while you were focused on, continuing to kind of make ends meet. And that's really one of the few remaining ways to get kind of beyond where you're at, where you're not just living paycheck to paycheck, or, even sort of expanding your lifestyle beyond, where you should be at. So, I graduated from business school in 2015 with the thought process of investing in real estate. And like many people, I started my journey in single family. So I continued to invest in single family homes until I ran out of capital. We bought 24 units in Ohio, me and my older brother. Learned a lot in the process. Along the way, we found an opportunity to buy 2 6-unit apartment complexes with some creative financing. So we did that. And I realized I know nothing about managing apartments. In fact, I was entirely reliant on my property management company, which will be lesson one for the day, which is if you're going to invest hundreds of thousands or millions of dollars into an asset like I have at this point, you better learn it inside and out. And I really appreciate Herb and Dr. Sanjeev and Asif for putting this weekly or biweekly together, because I've been on here a couple times, and I really genuinely sense that Herb is trying to scour as much information as possible for all those out there that take some time to listen. So hopefully this will be an informative day. It won't be so much about me. The cliff notes of where I've landed is I started doing multifamily investing as a passive investor because I was working a high stakes job where people were getting laid off. I had to put in 70, 80, 90-hour weeks in order to sort of make my 200, 250 a year annual income. And so I didn't have time to learn this asset class in as great a depth as I would have liked to during that period. But I did put my money where my mouth was and sort of invested my cash in other people's deals here in Texas. Those did very well. From 2018 to 2021, I invested in about 2,000 units as a passive investor. And in 2021, I sort of shifted gears and began actively managing these deals, partnering with people like Herb to take these things down and have a lot more control and ownership of these assets, and then offer opportunities for my friends and my inner circle and some of my acquaintances to invest alongside me. So since 2021, we've amassed a little over 600 units. And as I'll show you today, we are set to close in early November on another 195 units here in Dallas. So that'll put us a little above the 830 mark. I'm very excited to talk to you guys all about something that I love, which is multifamily investing and commercial real estate investing in general, because I have invested in a few other asset classes. But with that, I'll turn it back to Herb, because Herb, I think you wanted to start off and talk a little bit about the asset we invested in together in late 2023.
Yes, thank you, Gabe. Thank you for that. I will share my screen once again for just a moment, and let's talk a little bit about Treetop Apartments. This is an asset that we acquired in December 23rd of last year, by the way. And it's right there in Grand Prairie, right between Dallas and Fort Worth. And I'm showing some pictures. Gabe, can you see the pictures?
I sure can.
All righty.
I was just on site today. I went in to send some love to the on-site team and check in on them. And I'm really looking forward to taking a look at these pictures with a public audience, because it looks a lot different than when we took over in December. So go ahead, Herb.
It does. It's amazing what all we did to this so far. But before I go into the pictures, I want to show everyone, I just want to go over what we do for our investors. So every month we send out a letter to update everyone on how the property is going. And we include our in-depth financials. Like there's like hundreds of pages if you care to go in depth to our investors, right? So I want to go over, we're looking at a typical investor letter, executive summary, operations. We have our capital improvement details here. For example, it says leasing office renovations complete, exterior painting with new wood paneling complete, and new fencing around playground complete. These are items that were completed. Like, I think this letter is maybe a month old or so, but it's one of the last letters. Parking lot restriping and maintenance complete. Landscaping improvements are in progress. Lender inspection items in progress. Laundry room upgrade in progress. Spectrum internet cable infrastructure in progress. And so that's a typical monthly newsletter update that our investors get. So when you invest with us, that's what you get every month. And we include pictures of how it's going. Oh, by the way, recently we did a back to school event on the property, and that was well accepted by the tenants. So we create as much of an like a home atmosphere as we can, because we care about the tenants and improving their lives as well. So there's some pictures included here, and I'll share some more pictures in just a moment. But there's a monthly financial. So if you'll click on that monthly financial, and I won't go into depth, I just wanted to spend just a minute to show a typical investor what you can expect when you invest with us. You have the financial summary, then there's TTA rent roll, that's a treetop rent roll, and then there's trailing profit and loss. And there's hundreds of pages here, so I'm not going to go into it today, but that's what each one of our investors receives every month. So you're up to date every month. And so let's go into the pictures for just a moment, because we've been doing some amazing upgrades on the property. Treetop apartments, really nice, attractive signage. And just recently, and Gabe, jump in as you care to, as we go through these pictures, we did an upgrade. See the wood panel detail on the buildings. On the exterior, looks a lot nicer than when we acquired it a few months ago in December. Here is one of our model units. I'll move through these rather quickly, so if you want to watch a replay, you're welcome to. This is living area. These are in one of our upgraded units. We have a living area here. Here's the kitchen, living and kitchen area. So this is one of our upgraded units. So we have some partially upgraded, some fully upgraded units that we lease out at different price points. And here is our
leasing office.
Leasing office here.
Yeah, we completely renovated this from top to bottom. Got rid of the popcorn ceiling, put in a beautiful statement tile against the fireplace. There's one more item, obviously, as you guys might see some of the pretty stuff in there. I see the one item that stands out, which is we are slated this week to paint the inside of the fireplace. We just needed to buy the fire resistant paint so that we could put it in there just in case some dum-dum decides to turn it on. It'll still not have any problems. But we inserted a new coffee bar, kind of tailor this whole setup to our staff. I think it's really important to note that on these smaller value add projects, one, it's all about the community feel and the staff you have on site. 75% of your success is having great people. So hence me going to the asset today, buying everybody lunch, making sure there's smiles and hugs in the front office. And it translates to our success financially. So we've been able to sort of maintain a strong tenant base, even despite, doing a full turnaround on this thing. When we took over, it was 62% economically occupied. Nobody was paying. 62% of the populace was paying. And we had a lot of work to do. And we really knew that it had a lot to do with getting the right people in the front office and then sort of following through with on the promises of this wonderful asset that sits directly off of a major highway, a highway that gets over 70,000 cars going by it a week. So we knew we needed to take advantage of the location by making it look really pretty from the outside, but we didn't have some gigantic budget. We didn't want to waste any money. It is still an asset where every dollar matters and how you're spending it. So we chose to focus on the interiors, getting a nice renovated leasing office and model unit. And on the exteriors, we chose very specific locations to add accent and new paint. The rest of the paint job was only maybe a year and a half, 2 years old. And then there's some easy fixes, like stay on the pool for a second, go back to the pool.
Oh, yes.
We couldn't show our aerial photos when we first took this asset over because the pool was consistently green and disgusting.
Yeah.
We knew going in that we were going to have to sort of liven up that area, and it hadn't been open. It had not been open by the previous management. So as soon as we could, we got this thing ready to go. We just barely made it in time for the Memorial Day weekend. So we kicked off right when things were getting warm. And this is one of the most well-attended pieces of our entire property. Both this and the renovated playground have been a really big step forward. I think as things cool down, we'll see more people taking advantage of the playground area. Also, if you just go back to that last asset, oh, great. Thank you. That's the cleanup of the dog park that was terrible beforehand. But so one of the things you should note is there's these big concrete, we'll call them retaining walls all throughout the property. And they looked absolutely terrible when we first took over the asset. Um, we hired somebody to go every single day until the job was done, and clean off that with actually what we did is to save money, we purchased a power washer in-house. So that allowed us to sort of make sure that we took care of that project, not just today so that it looks pretty, but on a quarterly basis. The stain of the new fence that we lined up behind the playground was a really important aspect. And overall, I mean, it's self-evident. You go to the asset now and you can see that we're getting a higher base of tenant applying. Our property looks the part in terms of our rent increases that we're pushing. And we're also able to do a couple new things that you couldn't do without some renovation, including with the renovated, updated laundry rooms. We've actually now purchased the ability to take all of the rental income, so all of the income from the laundry machines, as opposed to just relying on a contracted vendor to go in there and do a 90-10 split where we only get 10% of the income. So as these area shots will show you, we're really well located right off of President George Bush Tollway. And across on the other side, you can see that is the headquarters for Lockheed Martin. It is an irony to me that in addition to working with Herb and Asif on this particular project and Eagle City Multifamily as an organization, we've also been able to partner with two amazing operators out of Colorado who are both former rocket scientists out of Lockheed Martin, Alex and Sarah May. So it was quite the full circle experience. I'm very happy with the property. If you see the group of trees up above, or to the left in this picture, very interested in partnering with anybody who's able to take that down with me. We are considering some point in the future taking it down and developing. Obviously not in the near point, because right now construction loans are frozen and it's very difficult to do a construction loan. But long term, there's a lot of opportunity to build in and around this area. And it has an appetite for brand new development. In the far distance, in the upper left-hand corner, you can see the new Grand Prairie Convention Center. And it has $4 Yelp review restaurants all in that area. Everything is over $1,000 more a door than what we currently have. So what we liked about Treetop is we saw that development happening one exit up. There was also solid jobs one exit before. And we felt like this was a great location to sort of make it as premium of an older asset as you can find, so that people can afford to live there, right? Everybody's got to have some affordable housing in a neighborhood. They don't want to have to travel from 3 or 4 miles away to get to their jobs. But that now it's such a convenient, easy option that we can build a community that's maybe 5 minutes from the job, 3 minutes from the job, 4 minutes from the job. And so we really did a good job on the exterior renovations and the interior turns. And now we just have to sort of, continue to move down this path of filling out the asset and then getting those dividends back to our investors. We did a distribution about 3 months ago, so we're about to do another one in a couple of weeks here. And our philosophy is, after we've made sure that we've got enough bankroll to handle expenses, all free cash flow gets distributed to our investors. So the way that this shows up a little different from your typical investment in, say, a stock or another investment in real estate with, say, a REIT or even a public or private debt fund related to real estate or equity fund, is that this is a syndication. It is specific to this asset. You're not buying a ton of different assets. You're betting on a win on this particular location with this particular team. And if we over deliver, you get all of the benefits of that. It's not watered down by it being treated as one of many bets in a real estate play. You are betting on the Mid-Cities region, this Grand Prairie location, and you're betting on this team to do the value add turn that we've already been able to do a little ahead of schedule here. The other thing to note is that you've got access when you do a syndication like this. And I think that's really something that gets missed. I was just at an event and we had some lovely presentations by public and even private funds, which are awesome tools in themselves. If you want some of the aspects of a fund, you can oftentimes find a little more watered down total returns, but a little more consistent cash on cash returns, which is great. You're going to get a big bucket of things to invest in. But what I like about an individual syndication is you have an individual team whose head you can come for when you have questions. So if something's going wrong on the asset, you get to ask the specific person. You can't do that on a fund. You're not going to be able to call the fund manager and get a thorough explanation of exactly why the returns are what they are. You're just going to get a number sent to you. When you have a specific asset that you're investing in, you can also make educated guesses. I think a lot of the people that I know that invest in my deals are in it because someday they want to be in the position that I'm in, which is, sort of really having a solid knowledge of a market and betting on that market. Now, I'm not saying everybody wants to be an active syndicator. That's not the goal for everybody. I don't think it should be. I think people are oftentimes very successful in their individual businesses and are using sort of the tax benefits and income from this intelligently as passive investors. We just had a conference with 700 doctors. Doctors don't have time to learn real estate as in depth, but I do think doing syndications allows you to see the monthly, weekly, even daily feedback if you needed to, because you can call the sponsors in between those weekly newsletters that you get. So I think it's a really great way to sort of open the door to getting more of a dialogue about what works and what doesn't in commercial real estate. And with that, I'll turn it back to you, Herb, but I really appreciated you pulling up these pictures of Treetop.
Oh yeah, that's all I wanted to share of Treetop, and an amazing detail about Treetop. We are cash flowing, and I think on that last newsletter, we're like within 11% of our projected returns already. So it is doing very well, to say the least. And yeah, thank you, Gabe, for talking about that. And let's you have some slides to share on this next deal we have under contract. You want to talk
100%.
about that for a minute?
Yeah, 100%. And before I turn the page on Treetop, I just want to say, look, Treetop is in Grand Prairie, so it has an amazing location. But I don't want you to think everything is all sunshine, butterflies, and roses, right? The commercial real estate market right now, you see stuff in the news, recession coming our way, floating rate debt has been problematic for some owners. Obviously, Treetop is a fixed rate loan assumption, so that wasn't the problem with that asset at all. But I don't want you guys to think that it's all sunshine, rainbows, and unicorns and fluffy and perfect. But the beauty of having a pretty strong, if not one of the strongest teams that's dedicated to a specific region is it's not just another number to us. We have well over 15% of the LP investment on that deal. We have our own cash invested in the deal. And we are very committed that no matter what comes our way, any problems that you can foresee coming up related to the economy or a recession, we're hands-on. We're going to be there like I was this morning, making sure things are turned in the right direction. So, despite all the good news thus far, there will be bad news at some point on every deal. You want a sponsor that's going to be honest about that, upfront about that. Hey, here's what's going on. Here's how we're mitigating it. And you really don't get that in other forms of investment. I like the syndication model personally for that. It's not the only model, but it's one of my favorite aspects about syndication, sort of the open book related to your asset. If your sponsors are those type of folks, which my team thus far, I love working with Herb. He has these kind of conversations where I get to jump on and share a little bit in detail. But our investors definitely know that they can call him, they can call Sanjeev, they can call us if things are sort of not where they want to be.
That's right. Thank you, Gabe. Yes, we are the operators. Call when you have questions. You can drive by the property for those in the local area. So it's a great thing. Great investment.
Now let's talk about today, right? Because we bought Treetop with this great fixed rate debt. So, that's December 2023. Let's talk about something more current. Let's talk about the kind of things. This is not a pitch of this deal specifically. The way I've structured is actually more educational. Herb, can you give me the ability to share screen? I think I want to take folks through the actual slides.
Yes.
But there's a lot of question marks of like, well, let's say I went full cycle in a deal, or let's say I just cashed out some stock or did something, and I really want to make another play on some commercial real estate, some apartments. What should I be looking at? And so before I show any slides, I do want to say I think what you should be looking at are one of only a handful of strong markets. The reality is we have no idea what's going to happen economically, but we do see more of a risk of a recession than we've seen in a long time. And now they've been saying that for months and months and months and months that, we're going to do it and then we're going to have a soft landing. But the reality is we want to keep the door open for all options and be safe in all options with our investing. And so in this case, when we think about value add apartment complexes, I want to remind folks that these are actually traditionally very, very recession resistant investments. Unlike 2008, the next recession will not be a real estate recession. It is a recession going to be based on the increasing interest rates, should push some employers to cut some jobs, and we'll see how deep the cut goes. But if there is a cut of any kind, the things we want to remember are we want to go to where we have the strongest options for jobs and the strongest options for a growing population. And we also want to not overreact and really think of this recession as more close to one that resembles maybe 2000 and 2001. Okay, so forget about 2008 to an extent. There are some things to learn from 2008, but this will not be the same kind of recession if there is one. And you want to look to markets that have shown they've got some pressure because people are moving to them. So some of my favorites, obviously San Antonio and Dallas, Texas, very strong. Two places that I've invested within the last year, and strong because they have diverse economies with lots of people moving there. Outside of Texas, if you want to look at some of the other markets, I really enjoy and appreciate Nashville, Tennessee's. Couple of my buddies in my mastermind, Granite Towers, they invest a lot over there, and some of that ecosystem that I'm friends with. Great deals in Nashville because of that growth in the labor market there. And the fourth one that I really like, all of Florida is not created equal, but I guess the fourth and fifth. But Jacksonville and Tampa seem to demonstrate some really, really strong fundamentals. So those are the 5 places I'm looking at. I left Phoenix off the list because it's a little inflated. If you take a look at the cash flow and some of the guesses people are taking, I'm not bought into the concept that Arizona is as strong as the dollar amounts people have been paying at. But long term, it's shown some resilience. And so I put it in my top 10, but it's just not in my top 5 right now. I think it's a little overinflated. But has some benefits, that you don't see in other markets. So what I'll do is share with you what my favorite part of the Dallas market is. I've already bought there once. Big hint, it's right next to Grand Prairie. It's this mid-cities area. It's the area near the airport. I've found that headquarters are popping up right and left. So McKesson moved their headquarters there. They're a Fortune 10 company. They moved their headquarters to just down the road in Irving. Goldman Sachs is building a big operations up the road, and several other employers, including Toyota, are already located in this vicinity. I like the mid-cities areas because it's a little off the radar. It's not purely Fort Worth or Dallas, so I think there's a little bit less competition, and fundamentals are perfect. Again, near the airport, so for all the logistics hub necessary to be, all the jobs necessary to be close to the airport, it's got that. A lot of logistics jobs feed right into our apartment complexes in that area. In addition, it's close to downtown Dallas and downtown Fort Worth, so you can kind of pick and choose, and you get a lot of the benefit of that growth from both of the circles. It sits right in between. So the asset that I'm looking at now is actually a 2-property portfolio. We have been under contract on this asset and raised almost all the capital to close this asset, but we do still have a few spots available for it. And the name of this property is Avanti. It's technically a two-property portfolio where 137 units that sits in Euless is called the Avanti on Central, and 58 units, which sits on the Bedford side, is called the Avanti on Pipeline. There we go. And I'll go through this real quick, but as a learning lesson, I guess I may have breezed over this fact. The most important part about syndication is the team. It is the team. And making sure you have an experienced team that has done this quite a few times. Now, this is a select portion of my team. I've had a little bit larger team on this one because I wanted more people to be involved and to have the opportunity to learn. There's a lot of things to learn on this because this is a value add experience. Just like the Treetop deal, we expect to spend the first 6 or 7 months doing a lot of projects. But overall, I think one of the things that I picked up on post Treetop is a need for more involvement and hands-on control over the property management company. So this is a unique offering in that me, Sean, Herb, Asif, we do the financials and the communications, and we get our investors into these opportunities. But for this next deal, we are adding Brennan Martinez and Misha Kaufman, as well as Aaron Katz to our mix, right? We also have a lovely couple out of Phoenix who looking to deploy some of their investors into a deal in Dallas. So they sort of kind of jumped in on the deal with us, named Roberto and Jennifer Sebastian. They've been great partners. And they've really opened up a wonderful group of investors in the medical profession, which is what they're part of. But I want to introduce Brendan's capabilities because I think they're really important. At the end of the Treetop project, we realized that when you're doing a ton of small projects, it's important to have somebody whose sole focus is CapEx. Everything from organizing the bids from vendors to holding them accountable day by day and making sure they deliver and not hit you with some change order at the last minute. Also, when you take over a value add project, new CapEx projects pop up unexpectedly. And so we have on our partnership team for this next asset, Brendan Martinez, whose business CapEx Partners has been responsible for over 35 CapEx projects for apartment owners like myself, all about the same size of 100 to 400 units. Brendan is very knowledgeable about the vendors in the DFW area, and he sets everything up to get the best pricing so that we can deliver on our promises to our investors and not go over budget. As exciting, or I'll give Brendan a hard time. Even more exciting than Brendan Martinez. Brendan's a buddy of mine, so I like to give him a hard time. Herb's laughing because he knows Brendan takes jokes like that pretty well. But even more important than him is Misha Kaufman. So Misha has been for the last 6 years the youngest member of the Kaufman family. They are a family office out of the Northeast. He's adopted, half Russian, half African, but his very wealthy family that adopted him out of the Northeast. And they did the best thing they could possibly do for the youngest member of their family. Rather than give him everything and anything that he wants, because they've got a lot of money. One of the brothers sold the software company for $200 million and bought 20 apartment complexes with it. The dad's been investing in real estate as a real estate accountant for the last 30 years. He has had 40 LP investments. Many of those are continuing to show extremely strong returns. So the Kaufman family was doing already really well, but they added this personnel to their team. They hired Misha and told them, look, the best thing you can do is start at the very bottom. So we're going to bring you onto our property management company, and you're going to come in as a porter and work for 6 months, then assistant leasing agent for 6 months, then a property manager for a year, and then you get to be the regional over all of Texas. So he did that in 2016. Since then, he has shown that he has an amazing skill set. I mean, most regional managers worked their way up from the bottom, but very few of them have an Ivy League undergrad education. This guy's a Columbia undergrad, which is a good school. If you've never heard of Columbia, it's a really good school in New York. And then he got his MBA from Boston University, which is close to where his family's from, and also a great MBA program. So the guy knows his numbers, but he also knows everybody's job and role. And what I did is I became family friends with him long before I ever decided to partner with him. He's my Friday night hang. His wife's an introvert, mine's an introvert. They got along, so we hang out together. But what this all translates to for this opportunity is he has full control over a very robust property management company called Burlington Capital Properties, also owned by a family office. The kind of property management company that doesn't go out and advertise their services, but has 11,000 units. He controls through his family office and through his asset management company. He controls a large portion of those units, and he's stabilized everything in his portfolio. So he's looking to add something new. Anything that he's a part of, he also has to have GP ownership in. And so we decided to partner together on this asset. It will be the first time, and probably I will never look back, and I will never do a deal again where I'm not partnering with the property management company itself, because we have unparalleled access to information. We have hands-on access to the clientele, and so I guess I should say to the employees that we pick. And we've got this guy who's sort of a nutcase. He will show up, and has done this on other assets, 6 a.m. in the morning and leave at 7 p.m. at night, because he's not just looking at your asset as another one of the 15 or 16 or 17 in his regional manager, responsibility set. It is his baby. And he takes care of this thing like it's his own money, because it is his own money. He is putting his money in as an LP and a GP. And I love working with somebody that has the professional property management experience, but that's part of the GP. And I don't see it a lot, except for vertically integrated companies. So I'm very, very fortunate to have him added to the team, in addition, to some of the rest of the people that I put up here, and in addition to Eagle City Multifamily. High level, strong projections for this asset. The real win is in the upper left-hand corner. We are seeing 25 to 30% discounts on assets right now. I've been looking at this thing since it was 25 and 30% higher. It was $27 million when I first started looking at it. We got it under contract for 20.835 million. And then we retraded the owners an additional 600K of benefits for our team. We are getting it at just over $20 million. And that means that we have an opportunity to go in day one, extremely strong cash flow, but a huge value add component. So a lot of the deals that I see coming out, they're paying about 20K more. So they can't put as much money away for all of the potential issues that you see on an older asset. And they don't have cash flow as strong as we have day one. That 5.9% cap rate was based on 2 months ago data. I haven't updated it for this slide. It is now 6.3. So this asset has continued to show improvement in the month over month as we've gotten in touch with the seller and sort of told him how we wanted to see things done. He's been very receptive to it, and we've already started to see the turnaround here. The reason we got such a good price, though, is very straightforward. The current owner didn't have enough money to take this portfolio where it needed to go. They did not invest in some of the key CapEx pieces, and they got stuck with a property that used to be on one side of the street, low-income housing. Well, they weren't able to move to retail. They did a decent job fixing up some things, but ran out of money, and a boiler broke. They had no hot water on for over 3 weeks, no water at all for a couple of those weeks. A lot of people moved out, and people just didn't like the way it looked because they didn't put money into the exterior, so they weren't moving in. Turns out they put all the money into the interiors of this asset, so everything on the inside looks really, really good, but they struggled with occupancy. This asset is about 89% occupied, depending on which set of financials you look at, and the whole rest of the neighborhood is 94.4% occupied. Everything over there is getting filled, and rents are being pushed despite sort of the flatlined rents that we see across most of DFW. Part of the reason for that is this is a good neighborhood with amazing schools. I apologize again, a second typo on there. It is not Birdsville ISD. Birdsville ISD is top of the food chain. It's a very good school district. We were putting in edits on our most recent pitch deck, and we realized, oh, this is HEB Unified. It's number 4 in all of Tarrant County. Every school in it is a 9 out of 10 or a 10 out of 10. So HEB is our school district for both sides of the street. We thought it was half Birdsville, half HEB. We got the best school district possible. And it sits right across the street from one of the junior highs. So it's got a cool location because people kind of move into this neighborhood so that their kids can walk to school and walk back. They just don't move into this asset because the maintenance hasn't been done and people haven't really built a community around this wonderful set of bones that we see for the asset. Median income is very strong. If you know DFW, you'll typically see value add projects, older projects like this with like a 48, 52, 53 median income. This has a 61K 1 mile and a 72 3 mile. So very strong neighborhood. In addition, we've got a track record. Our team includes a couple people that I didn't call out by name, like Aaron Katz is quite a beast. He's been doing this for a long time. Has gone, about half of these assets in their management are just him. And he's been an advisor, a scholar, a decision maker, a strategist. He's been a wonderful teammate. I just had lunch with him today after I visited the property, the Treetop property, and this property. He's been a wonderful person to have on board. And, I have a lot of confidence in who we've put together for this asset. In addition, we did full due diligence using Omni Group, who's the best in town. There's 16 buildings for this asset. They need about $1.5 million worth of capital put into them day one. That's almost all exterior. The last 2 owners put $1.9 million into the interior. So we have really beautiful insides, very few classic units. There's a couple, but very few. And even some washer dryer connections, which none of the other assets in this neighborhood have. It's technically a B-class asset. I know it's kind of hard to stomach with the vintage, but you should note that one side has replaced flat roofs with pitched roofs. So it's got a pitched roof on the 1965 side. In addition, it has individual HVAC and individual electrical. So it's already been sub-metered. We're going to take that one step further and sub-meter the water. And we're going to make a ton of money by billing back utilities to our employees. This property right now is being billed as all bills paid. And it makes 0 sense because this is a strong economic community and no other properties for 5 miles in a big circle are all bills paid. It's the only one. And it doesn't make sense for the business plan And that's why they've really struggled as well. They're attracting the wrong kinds of tenants. They're attracting people that only make $40,000, $45,000, $50,000 a year. And this this asset sits right in the middle of a lot of great working class opportunities and jobs. And so we're going to sort of reposition it. And we've done some deep dive analysis on the leasing files. We see who's going to have to go, who's going to have to maybe downgrade in size in terms of apartment, and who's going to be able to stay with us because they make, you know, sort of enough money to remain at this asset. We work with people. We'll be thoughtful about how we do the transition. But at the end of the day, I think Avanti is going to look a lot different as a community. And for that, you know, we're going to be able to boost the income considerably. The beautiful part about this asset is that we don't have to boost income. In fact, the underwriting, we drew a decrease in rents. And that's because it's so under-occupied that all we have to do is push occupancy and collections, which is our real important piece of it, which we know how to do, but occupancy and collections up to market, and ultimately get things to where we're 10% economic vacancy instead of the 25, 30% we're going to have when we take over. And if we do that without increasing rents, no rent increase is necessary, we will have way overshot our financials. In fact, I've got some details on how that looks a little later in the deck. But I guess what I'm trying to say is this is a very straightforward business plan. And right now, I see a lot of people take over assets and they have to do 50 things right, including push rents, add other income, increase occupancy, you know, add Spectrum wireless internet cable, all these fun things to try to make it work. This deal doesn't have to do any of that. We are going to do some of those things. We're going to push rents, but when we do that, it's icing on top of the cake. This is an opportunity for us to simply stabilize the asset, and if we want, we can get in and out a lot faster than a lot of the deals you see out there. We're giving ourselves a 5-year business plan to pull it off, but you know, I see a very clear path towards an earlier exit, and that's how we've structured this deal. We're structuring our loan so that we can get in and get out. Here's a little high-level look at how much we plan to spend per door. I told you we only plan to spend about 1.5, 1.6 within the first few months after taking over. And that's because we've gotten all the bids back. We know what needs to be done day one, but this is an older asset. And so something I saw a lot of my friends failed to do, and a lot of acquaintances in the business failed to do, is when they bought an older asset, they didn't have a giant pot of money sitting off to the side because the deals barely made sense, right? They were fighting with these listing brokers and they didn't do a good job negotiating on the front end. I think we did a terrific job negotiating on this one, getting the asset down from 27 million to nearly 20 million. So the opportunity here is we'll have about 1.5, 1.4. We've got it earmarked for some things that you can't see day one that we know will be a problem down the road. Just older assets have problems with plumbing and, you know, deferred maintenance pops up later in the process, particularly with the plumbing aspect of it, which is, you know, one I just called out, but also sometimes with, you know, concrete or, you know, a piece of carpentry that we find, you know, sort of needs to be redone. There are a lot of small things that pop up on a regular basis. Drainage is another one that, you know, we've had and learned to really look out for. And although I had, I think, the best due diligence you could possibly have in that I had Brendan Martinez as a teammate, and I had Ken Waters as a co-GP and a friend who came by to look at some of the asset, and I had Omni Due Diligence, Brian Amos's team, go door to door, rooftop to foundation, you know, end to end. I ultimately think that you still need a big set of money set off to the side. So we have about $1.4 million set aside. You won't see it here. It's not what contingency adds up to, but there's some areas in here like $300,000 of HVAC replacement upgrades. There's nothing wrong with HVAC day one. In fact, sellers just replaced $200,000 worth of HVAC, and they did about $40,000, $50,000 worth of drainage and plumbing. So there's nothing wrong day one, but we have $300,000 set in there because I want to sleep good at night. I've owned these assets, even Treetop, right? I get the call at Friday at 4:30 when somebody smells gas and we have to do something, right? And that's the lifestyle I'm used to living. And I choose to live that lifestyle. And me, Misha, Sean, Herb, we're boots on the ground. We're going to figure those problems out. But if you don't have the money, there's nothing you can do to keep your business plan moving forward. So we have a giant chunk of money set off to the side, and our deal still works. $3 million is our CapEx and reserve budget. I think it's an intelligent amount of money, and it's going to make our investors sleep really well at night because we have a lot of well to continue to go back to for these older assets. And it's why I like this asset. It's a B-class asset in terms of its location, but we get to value add in terms of renovations and building a strong community. Floor plans, giant floor plans, a nice mix of 3s, 2s, and 1s. So it's not one of those properties where you have a bunch of tiny apartments and it looks really good, price per door, but the reality is like it's really small, so you're never going to push revenue. This has a lot of different options from a revenue standpoint. Families get to move up in size if they want to stick around our community. They can invite friends and cousins to come in the smaller 1 bedrooms and get a referral bonus. So we really see this as a way to have like a decent offering. 3s, 2s, and 1s are what me and Herb typically buy. Same with Treetop with this asset. We like a little bit larger units because this is meant to be a family community. I mentioned the schools, and that's really what people are moving for, the jobs in the schools. We are thinking of adding a few more washer dryer hookups, about 30 more. We saw some assets that have the capability to do so, and there's a big demand. In fact, I learned that from Treetop, which is only 10 minutes away from us. Treetop's pretty close by, so it's kind of all in the same little mid-city circle. But I learned that there's a real demand in Dallas right now. People are a little tired of those leasing, the laundry assets that they have to share with people, and they're really looking for those in-unit amenities such as washer dryers and patios. Here's the inside. I was telling you guys, it looks really nice inside. Yes, on the left, that is our standard upgrade. That's what most of the insides look like throughout both properties. In addition to your standard turns, like you see on the left, we have a handful of diamond upgrades that we're adopting, that we get from the last owner, but we're going to add about 30 to 40 more of those, and we're going to ask for a $250 rent lift on those assets. The main reason for that is that's the business plan for the next owner. Once we prove out the stabilization, once we get this thing freaking looking beautiful, top to bottom, no ugly brick, no ugly paint. We've got like a cream colored paint. It looks terrible. We're going to make this thing look new and beautiful, like all the rest of the assets in this community that have been sort of freshly painted up and had the Mansford painted black so it looks modern and not 1960s and 70s. It's going to look pretty. And so we want to prove to the next buyer that there's still some meat on the bone, and that'll come through diamond upgrades. The next buyer will get something with maybe 45 of the interiors upgraded to diamond, and we'll prove that out. We'll let them know what the costs are and what the benefits are, and then we'll let them buy this asset and do the rest. And that's sort of the business plan and the exit plan. Again, I mentioned from the air, you've got an asset that is sitting in a good community. In the upper right-hand corner of the bottom picture, you can see the edge of the baseball field. I think or maybe it's the track field, but it's for your consideration. That's where people would just be able to walk right to get to school. There's really great bones for the amenities. So a big playground area, giant playground area. We're actually going to turn that into sort of a turf soccer field because the kids really don't use it as much as we would want them to. And then there's this beautiful greenery at the front, right at the intersection of 2 very busy streets, Central and Pipeline. We're going to make that amenity central. So there'll be a xeriscape, a big mural, and ultimately like a sports court is what we're thinking to add in there. Because this place should be someplace the kids are excited about and tell their friends to come over and hang out at. It's right there near the school. Instead, we've been searching our comps for months on months. I told you guys I've been looking at this thing for since mid last year when it was $27 million. We found that the general sentiment is this is the one little black eye in the neighborhood. So in addition to doing the rehab, we actually have a public relations campaign set up. We're going to work with the city. We're going to work with the police. We're going to work with the entire neighborhood community organizations. And we're going to get the mood changed around what people think about around this asset. Now, I should be clear. This isn't a dangerous asset. I bought those before. I've bought assets in $40,000 and $45,000 median income neighborhoods. I know what dangerous assets are. Crime in this area is very low, but sentiment is still really important. If we're going to do a value add turn, we want to make sure we're getting sort of the best that we can. And so that's what we're doing. We're really leaning into both making it look physically pretty. I mean, you can see some of the dated touches on it from a distance. We're going to completely redo the flat roofs so that we don't have to worry about it. And what that does, it's a big expense. It's a really big expense. We bought a GP whose specialty is roofing onto the project. And he actually brought some investors, brought a ton of his capital, and he will be focused on it. His name's Ken Waters, Mr. H2O, he calls himself. and he's actually bid out that project and saved us about 200 grand on it, but it's still a giant project, about 600K. But once we do that, it immediately increases the value of this asset by how much we spend. It's one of those things where we're going to be able to offer a 20-year, 30-year warranty on it and pass that over to the next buyer so they don't have to lose any sleep about the roofs on this asset. The pitched roof asset side is really good. Roofs are strong. We'll do a little replacing here and there, but for the most part, this asset is going to look fresh from the outside, but also have some of the most important things like the roof, like the plumbing, sort of rehabbed and renovated, so that they're in sound position as we look to get in and out of this thing pretty quickly. Now, if you're looking to get in an investment that has a longer horizon, I would recommend getting into a newer asset and getting into something, that's going to have some fixed rate debt that stretches out 10 years. That's not this project. This project is a true value add. It's got a ton of very quick turnaround, especially on the occupancy side. And, proof of that is sort of in this chart here. Everything else, including our rent comps, but just the entire neighborhood has a much higher occupancy. And so what we realized is if we close a portion of that occupancy in the first few years, we'll have already met our business plan. And if we close it all the way, we'll have exceeded our business plan. And closing occupancy is something that we did on Treetop in a matter of 6.5 months. And we didn't even have our full-time professional real estate teammate, Misha Kaufman, to be there every day to sort of, even more handhold the marketing and the success of the leasing agents. So I think this asset is one of those where, if you want to get into an asset that has a quick turnaround, I see a lot of outs for us on this business plan. Just look at it compared to its closest comps, and you can see that it's going to involve a lot of work to get an occupancy close. It's easier said than done. But this chart here is Misha's performance. These are just 2 of the 6 assets that he runs in Dallas-Fort Worth area. And I mean, look what the guys have been able to do in just 2 years, right? While all the other people in his peer group have struggled to refinance cash neutral, he was doing cash out refis for his family members that had bought some assets on floating rate debt within 18 months. The kid really knows what he's doing. He's kind of a nutcase. Again, really smart, super sharp guy, but it's more about also having that alignment to the business plan and alignment and goals because he is a co-GP. So Spring Oaks is in South Dallas. So it's actually a rougher neighborhood. And he was able to have those sort of returns and that success. The one that I want to call out is Centerville Point. That 250 units is in a community very similar to ours. It's in Garland, Texas. And as you guys, if you know Garland has an interesting mix of lower income, kind of sneaking these little pockets of low income around a community that has really changed and increased its median income, generally speaking. So Center Point, just like Avanti on Central and Pipeline, used to be a lower income neighborhood and has sort of transitioned into having, some pockets where you're going to see some upper end working class community members. Misha repositioned the asset and basically repositioned the tenant base so that they were drawing from that higher 55, 65, 75K median income community, as opposed to that 35 and 45 and barely making rent and skipping out on rent and causing evictions kind of community. So he did a really good job with those 2 assets, but it's just one of the 6 success stories he has in his Dallas portfolio. And these are the only things that he does. This is what he does when he wakes up to when he goes to bed. He's a little bored right now. He does golf every Wednesday morning because he's stabilized these 5 assets, and he's extremely excited about taking over Avanti and Avanti on Pipeline and Avanti on Central, because it'll give him something to do, which is something that he's good at. What we're seeing right now, today, not back before, but right now, today, is deals are trading in this neighborhood in between 145 and 190 for comps, not brand new that I'm telling you is a comp. Like actual comps in this neighborhood are trading at a much higher premium. Other B-class assets and even some of the C-class assets in our marketing and our comp mix from CoStar are trading already between sort of the 140 and 190 range. We're picking this thing up at 105. We'll be all in at 125. And all we really need to do is get this thing to a place where it's selling at today's market rate. So this is, again, one of those storylines that I keep repeating is if I'm buying today, forget if it's a Bonte or my deal. The point is, if I'm buying in today's market, I'm looking for value add opportunities where things are not projections based on hopeful assumptions about what people can do in the future, but based on the reality of what's happening today in the market. That way, if things do improve from today, well, great. That's gravy. That's bonus. It's extra. But if they don't, you're still in a strong position to meet or exceed your projected returns. A little animation to kind of show what we're talking about here. We purchased this at 104. That's a huge gap. Huge gap. And this is the type of business plan that I think we can reasonably do in a year and a half, 2 years. We are giving ourselves 5 years. Our pro forma is based entirely off of a very reasonable closing of the occupancy gap over a 5-year period. I do want to start to wrap up, but I wanted to show you guys, for the number people, for the numbers driven people, you know, I see a lot of deals that have 40 or 50 things that need to get done in order to be successful. I just watched one of my friends close one, which is great. I love them. And they're amazing operators. If anybody can pull off the business plan, they can. But they bought something that, you know, the rents are currently like $1,070 a month. They're trying to get up to $1,400 a month. So to do that, you got to add cable internet. You got to change your laundry vendor. You got to renovate every single unit on the asset. And you got to clean up the exterior too. And you've got to find some way to get management that's good. So when you add all these different things that they're trying to do together, you can get there. In this case, I took the numbers. Again, we've given ourselves 5 years to do something that I don't think will take us that long. But even if we just brought things occupancy to market and we started billing back their water and trash, we don't even have to bill that back entirely. We can just get $100 more from that other income. We don't need to roll that in year one. We could roll that in year 2 and 3, which is what we did for our underwriting. And then we add, you know, a couple washer dryer connections. We'll add over $1.1 million in annual revenue. And you know how these things are sort of calculated. They're calculated with a cap rate. Here's the fun part. Again, we bought it such a good price. If you take that cap rate of 6%, you're going to have added 16 million in value. And ultimately, really, to double our investors' money, all we need to do is add $11.3 million in value. So it's a lot of value to add. I shouldn't say all we have to do. But my point is, as you can see from this math here, we'd be in a really strong position. Another thing that you should note is that CoStar and RealPage have this thing today as a 5-year exit cap. They have a 4.85. So 4.85 cap is what CoStar has. We're underwriting it at a 6. It's a 1960s asset. I don't care what CoStar says. I'm still going to have to go to the market and find a buyer. I don't want to lose sleep at night, whether it's 5.1 or 5.2 or 5.4, right? So we used 6% and this thing still worked. And we were like, all right, let's go. We got a deal now. Like if Tom Lafferty's giving me the thumbs up, you know, if Adam Roberts, these are my coaches in the Sunrock ecosystem that I'm a part of and that Hertz a part of. And these guys have tons of assets. They review all of our deals to make sure we're not messing up on anything. And they were like, look, you're good. If you're good at six cap, like I like this deal. I'd consider investing in it. So it's a very exciting sort of result for us in terms of our negotiations to get this thing down to 20 million and be buying in such a good neighborhood. We've got a deal where we kept most of the expenses pretty flat. Contract services stands out. I just want to call out why we took $20,000 off of that. They have a trash services contract that they should be paying a lot less, but they ended up paying $303 per door for trash a year. And that was because what we caught when we visited the asset a few times on the weekends, there was a few companies, commercial companies, that are dumping in their dumpster. So they've had to pay 3 times as much as you should to remove this giant dumpster in the back because they don't have a freaking security camera on it. So in our business plan, we have a brand new security camera. We're going to catch the problem and we're going to finish the security gate around the asset so people can't come in and dump their stuff. Problem solved. Now, just to be safe, we still underwrote at well over $200 per door for trash, and that we still got the 20K in savings there. On my other assets, including Treetop, we pay about $150, $160K per $150 or $160 per door per year. So, you know, again, we're being a little conservative based on very similar sort of fundamentals on our other assets. And again, I did the math on that wrong. we pay a ratio that would have put this asset at 150 or 160 a door. We pay like 103 a door on a smaller asset. But the point is that we think we can save some on contract services, and on utilities we kept them flat, but we just renegotiated the electrical contract. So we're going to go down from paying 4.6 cents per kilowatt hour to 3.99 cents per kilowatt hour. So, we pro-formed it at a higher number, but we think these are completely reasonable. Maintenance and repairs should be lower in year 1 and year 2 than you see here, but we kind of kept it even because we didn't want to, misrepresent. The first 2 years of a heavy value add, CapEx is what you're spending. Repairs and maintenance is not what you're spending. You're spending very little on make ready, so nothing really appears above the line. But long term, you really need to consider your make ready and repairs for when you go to sell it. So we kept it sort of flat on our underwriting. We think we're going to want to put a lot more into marketing than the current ownership is, but we have some smart, low-cost ways to do that. That's a real insurance quote. We're good to go there. And for property taxes, we successfully sent our offer and our contract to the tax authorities. So they have already reduced the expected property taxes down to what you see on our underwriting. We were able to go directly to the authorities with this proof that we paid $20 million for it, because the authorities of the taxes were saying the valuation is $27 million, just like we were seeing it offered for out there. So we went directly to them and said, hey, we're under contract for 20.835, bring the price down to that number. And they just delivered on that a couple of weeks ago. So we're feeling really confident on that property tax number. We do have some growth in property taxes and insurance. We put 10% in for the next few years, and then it kind of levels out at 3% into our underwriting. And we put for property taxes that even though we will be at 100% of what we paid for this thing, and we should probably be able to get it a little lower than that, we're going to show at least a 7% gain over the next couple of years because tax authorities do crazy stuff. So we just want to be safe on our expenses. This is the Sumrock Analyzer. I think a few key things to point out are that other income is going to stay relatively flat given how much more other income we're going to generate on this asset. And we did that because we wanted to push all of that to year 2. The reality is when you go from all bills paid to bill back, it takes a little while to implement. You got to do it at renewal or with new tenants. And so we pushed almost everything out to year 2. We pushed 80% of that change out to year 2. And we really took our time showing how quickly we're going to get to sort of the lower of vacancy than they currently have. And CoStar at the time was 5.07, but today it has become 4.85. So they're really looking at this neighborhood and seeing its growth. The 5.07 was from our underwriting in March and April when we took it out, when we were underwriting it. The CoStar report I have is from last month, late August. 6% reversion. Yeah, nothing too tricky on here. All the growth rates are from CoStar itself. So those projected year 2, year 3, and year 4 growth rates are from CoStar. Yeah. Oh, and then we did some break-even analysis. I think every investor, just again, I kind of made this about my deal. I apologize. I really wanted this to be about takeaways for you guys. So from an educational perspective, always ask the syndicators or even the fund managers sort of, what are some of the break-even analyses that they've done? Because you really want to protect your downside risk. And so for this asset, what we realized is we wanted to take a look at some of the scenarios where maybe the break-even point would be reached. And so for that, we thought, okay, what would be the worst case scenario from an economic vacancy perspective for an entire year in order for us to just barely be able to pay our bills? And we saw that this asset, because of the price point we're buying it at, can be 60% occupied or 40% vacant, 39.6 to be exact, I should be careful. And so that was a cool analysis. I see that as a really strong proof point that we can get in there, kick people out that shouldn't be there, fill new people back in, and still be able to pay all of our bills and cash flow for you guys. The other thing is like flat rent growth. What if Dallas, Fort Worth in the mid-cities areas all of a sudden decides to not have any rent growth for 3 years? What would that look like for investors? And it would be an 11% annualized return. It would still be a double-digit annual return for our investors. What if the expenses were higher? Very similar to the economic vacancy. If expenses were about 40% higher, we would still break even. And what happens to this thing if we exit at a lower cap? Well, the returns just kind of skyrocket. I don't need to go through those. I think the point is, we think we can do this business plan faster and exit at a much stronger exit cap than 6%. But this investment still works, even under the parameters by which we've laid out our initial analysis. Closing thoughts. I know it's scary out there. You got a bunch of people on floating rate debt deals that are struggling to cash flow. And so it sucks. You got an environment where people are going to miss out on these wonderful, wonderful opportunities that are coming through because sellers are having to sell these assets and there's nobody out there to buy. And I'm out there to buy because I see an opportunity to be a little greedy when others are fearful. I'm not saying make silly decisions. I'm saying truly understand why people are fearful and don't think with your, fear mind tuned in. Think with an analytical brain and find opportunities that they're not seeing. In this case, I'm seeing opportunities in Dallas, San Antonio, Nashville, Tampa, and Jacksonville to buy value-add apartments, B and C class, not A class, because A class is competing with brand new builds, and A class is feeling the pressure from a potential recession a little stronger than B and C would, right? Because people are going to move from A to B and B to C. So this asset is the ideal thing to have in a potential recession environment. It's the ideal thing to have when you've got discounts, but also really high interest rates. Because our business plan is based on closing occupancy, not on boosting rents through interior renovations. And our asset is a B class asset that has heavy value add. So we're going to be able to offer rents significantly discounted from our A class and our B plus peers in the neighborhood. And with that, I'm going to shut up. I appreciate you guys letting me talk on and on. I get passionate about this stuff. It's really fun to me. And, teaming with people that I can be in a long-term business marriage with, like Eagle City, is like second to none. I have to be able to poke fun at Asif. Asif has to be able to poke fun back at me. I think that's a big part of it. I've seen too many of my friends get into these deals where things are tough right now, things are struggling, and they don't have a good chemistry or dynamic between their partnership and everybody on it. So with that, I'll turn it back over to Herb. If you guys want to ask me any questions, I'm happy to.
Oh, absolutely. Thank you, Gabriel. And you are fun to go to work with every day. Every time we get to meet and do business, it's a pleasure for sure. And I want to just open this up for any questions for anybody live on the call, and also anyone that hears about this, the recording or anything. Please reach out to us, and as long as there's a few slots open for investors, it is open. So just want you to know that. And you have contact on Facebook and YouTube. We do monitor those. So please reach out. Sorry, I was muted. Sorry about that. We're doing our fun little thing here. We're spinning this spinning wheel. Can you all guys see it spinning? We're picking one lucky winner for a draw for a Starbucks gift card. So one of you guys will walk away with a Starbucks gift card.
Edward. Awesome.
You got it. We'll email that gift card to you within the hour.
Thank you.
Enjoy. Any questions? Come off mute. Ask questions. Have any?
Yeah. Look, I talked a lot about Treetop and a lot about Avanti, but I'm happy to answer any questions about other multifamily assets, particularly if they're in the DFW or San Antonio areas. And then in addition to that, I'm happy to sort of add my time to your calendar if you want to talk about things outside of multifamily, because I know there's a lot of questions related to that. And I've been taking a look at it myself and just trying to understand what's going on. And I still am doubling down on multifamily as the right move to make right now. But I'm happy to share some of the wins, upside and downsides of some of those other asset classes. My email that's easiest to connect with me is chatwithgabriel.com. That feeds right into my calendar. So just chatwithgabriel.com. And also, me and Herb are a phone call away. So if you ask Herb a question and he doesn't have to answer, I'm happy to jump in. Same with Asif and Sanjeev.
All righty. We're going to wrap this up pretty quick, but if anyone has a question while Gabe is on, please go ahead and unmute yourself and ask the question. I'm sure you have some questions about this, either one of the deals. Edward, Chris?
I was just gonna say, Gabe, I had no idea you knew Herb. I met Gabe. Gabe, you probably don't even remember me, but my wife and I met you at.
No, I totally. Yeah, I remember you, and I also remember Chris. I've met both of you guys before. It was cool. I've seen you guys in the flesh, and I've seen you 2D now. But yeah, I know Herb and I partnered on Treetop, and Asif, Herb, and Dr. Sanjeev have really formed the heart of Eagle City Multifamily, and they've been get out there and educating people. So Herb hit me up earlier today. I was like, hey man, you want to jump on and talk a little bit about Treetop? I said, absolutely. It's one of my favorite things to do. I used to be an educator, so I like running my mouth about this business and sort of I guess I gave maybe too many of the positives today, but if you've got any tough questions for me, throw them at me. I think it's often that people talk about how great of an asset class or an investment strategy this is, and it's true. But I think, it's important for us to talk through sort of any of the headaches or any of the risk points that we see, because I think people should be, sort of given both sides of the coin. So I don't know if you guys have any questions, I'm happy to answer them, or we can talk offline.
Hey, Gabe, what's the minimum investment on this?
What was that? One more time, Chris.
Minimum investment?
For this one, it's 75. We're looking to sort of show some flexibility for first-time investors. So if you haven't invested with us before, hit us up, let us know what you got going on and whether the timing works. Again, it's always about timing. So I think this is an opportunity for us to sort of work together, and we'll make it work.
So the recommended minimum is $75,000 for all those who didn't understand.
If I told you that I had not let anyone below that minimum, I'd be a liar. So we can talk.
When is this window coming to close? Do you have any idea?
We're going to close mid-November. Well, we just got off with the listing broker. We're aiming for the middle of November. Obviously, it's more about getting the paperwork done than it is about necessarily getting the wire in. I try to work with my investors to get that wire in, as close to the closing deadline as possible, because I understand a lot of people are liquidating other assets in order to move into here. So I want those things to be able to grow for as long as possible before they move over. So it's just about coordinating with whichever sponsor you jump in with, whether it's me or Herb or whoever, and sort of talking through the details.
Thanks. Thank you very much.
100%.
There's nothing else. We will wrap this up for today. Went a little longer than normal, but it was well worth the time. Thank you, Gabe. Thank you again.
I appreciate you guys. Thanks for letting me pivot. I apologize. Yeah, go ahead.
One thing before you go, Gabe, you guys did awesome as a masterclass on Avanti Apartments pipeline, because I underwrote that. It was like one of the first properties I underwrote because I'm learning all this stuff.
Yeah.
And I'm excited for you on that property. I'm really excited because I felt like, wow, that I just learned so much. We should
dive into the details sometime too, because when you're underwriting right now, I think it's really important to have had some context of 2018 and 2019. A lot of deals then got locked into these longer term pieces of debt, and it put them in a position where there's nothing on our Sumrock analyzer to go back and put in what our prepayment penalty is going to be, but it's a giant number. So it kills the business plan for a lot of these deals that are getting these longer term loans locked in. And don't get me wrong, some people love those because, cash flow starts to stepstone its way up and it becomes a little bit of a cash flow opportunity. I'm in this right now to get my investors a quick return and a big pop at the end. I'm just being blatantly honest about that. I will get cash flow and I will distribute every piece of cash flow possible. Herb knows, Treetop, we've been distributing, about a month and a half early, but that's not my primary goal. My primary goal is to find business plans that are quick and easy and straight. Easy is the wrong word. quick and fast and straightforward, not overly complex, not overly filled with all this risk that you can't see. So Avanti became better, but only after we negotiated it down to where we landed it. If we had paid anywhere near what that listing broker wanted before, we'd be screwed. They were holding fast at 24 million up until all the way up through December of last year. Even when rates had climbed a whole ton, they didn't move down very much from 27 million, even though I guess 3 million is a lot, but relatively they should have moved down faster and they would have made money. Then the new year starts, they get under contract at 22.3 million. I lost the deal in March. It wasn't until May that they came back to me and said, hey, first place couldn't get to the finish line. They didn't even get the under contract. They just sat in negotiations for 3 months before even getting a PSA signed. So we had an opportunity and I knew they were really hurting. So I said, well, my $21.5 million offer is no good, 20.835. And then I also asked them for early access. And when they said yes to that, you know, we knew, I was telling Herb about this before, like we knew at that point we were going to be able to retrade him. And we did. We took another 600K worth of benefit off the table. And that's the only reason this thing works. If you just say yes at the first instance on these deals, like these deals have to be made. The underwriting's not going to work. Even right now, the underwriting's not going to work that great. You've got to go in there and negotiate hard and push below that whisper price, because that's not the bottom line right now. These sellers are in a desperate position. That whisper price is not really where the rubber meets the road. And you've really got to be able to figure out what is the right spot where the rubber hits the road in order to make some money. So thank you for bringing that up, Ed.
No, I really appreciate it. Thank you. Really good learnings.
I'm gonna wish you guys a good night. I'm outside at Starbucks. It was really cool during the end of the day. I had to call her and be like, oh my God, my internet completely went down. What do I do? He's like, don't worry about it. I do this from the library from time to time. Like, go to Starbucks. So I did. I'm set up here, but it's dark now. So I'm gonna wish you guys a good night.
Oh, it's perfect. Thank you.
All right. Bye, y'all.
Thank you.